Hey guys, Freaky Finance here. Today's going to be a different video. I'm actually leaving on vacation for 2 weeks, so I'm heading out to Nashville and New Orleans to go into the States for a bit. So today's video is going to be a little bit different in that I'm going to go through, I haven't done this for a while. I used to do this, I think, on this channel once every year or at least once every 6 months, but I haven't done it for a while. So we're just going to go through all active positions relatively quick. There's 55 of them, kind of just how I think about things independently and then also in the context of our portfolio and kind of where I'm trying to find value. Lately, a lot of things have gotten appreciated in value, so it's harder to find easier places to find value. But there's always some, and I like to turn over rocks. So if you guys have any suggestions as companies that I could do for the channel, I'm always interested in turning over more rocks, especially on vacation. So I'm just going to run through them really quick. So I still own Advantage. We've never done one on Advantage, but just a very low cost LNG producer, a natural gas producer in the Montney in Alberta. They also have an entropy kicker, which is like a carbon storage unit. Bank of Nova Scotia owns in a couple accounts. This is one that was just really cheap for a long period of time, so it's recently appreciated a little bit, actually ahead of the fundamentals. So things are just not less bad in terms of rate of change. They're not getting better yet in Canada. They're still taking higher provisions because what they're trying to do, and this will work for BMO as well, we'll talk about them. All the banks basically try to provision ahead of time weakness. So what that means is when the credit cycle starts weakening, more unemployment goes up, they try to increase their credit provision. So you see the EPS go down in terms of rate of change as unemployment picks up. Most of the models haven't assumed anything over 7% unemployment in Canada. So when we start getting to that 7% range, you're going to have to see more of a rate of change increase again in the provision cycle. Now they've been managing, the thing about the Canadian banks, they've been managing this for over a year now. So the earnings per share has already been lower than it would have otherwise been had they already taken provisions. So what I mean by that, it's hard to get worse when you're already taking things out. Now it's possible if things slow down dramatically that they had to do a big provision, and then you get a really easy entry in the Canadian banks. But so far they've been taking down, like I bet you these banks all put up $1 or $2 in earnings power depending on the bank, more than what they really are. I mean, they've taken that off already. So once those provisions finally stop and things actually start getting better, instead of still slowing down like they are now, and still are in Canada, then you're going to see the pickup in the Canadian banks. And that makes it tricky, right? Because what I've found over the years is that the banks really go, the valuation comes in hard when there's a rate of change slow down the provision cycle. And that's usually your easiest entry into the bank. So it's hard to get excited about them right now. CTF is just a small cap Canadian tech company. I won't get into that. I might just sell it. PayPal, I think I've done one on this channel. Very cheap, high grower. It's got during the switch from commerce goods to services during the COVID reopening, PayPal got hit pretty hard because they make most of their money on goods first off, and they make a lot more money in terms of margin in terms of the FX spread. So what that meant is that their margins came in and their sales growth slowed. So you had G slowing with margin compression. Now you also had Braintree. We already talked about this, outgrowing the core brand business of PayPal. And lately they brought in a new CEO. He's done quite a lot in terms of the product development side, which is hopefully going to keep driving results. Honestly, PayPal's not asking for much. This thing could go back to 20 times earnings or 22 times earnings, right? I mean, just in line with the market, and you'll get a decent appreciation on PayPal. So that's a nice one in the portfolio. Shopify is just a strong position. Again, it's harder to get excited about the Canadian economy, but Shopify has corrected quite a bit, and it actually keeps growing year over year. They decided to pull back on that fulfillment side, which was great because that was going to be a big weakness in terms of they're trying to figure out this distribution side for Shopify, where this is far better if they just don't deal with it at all and keep a CapEx light model. Vermilion, we're going to talk about that one in a bit. It's actually, I have quite a bit in it, more than I expected between all the different accounts. This one it's trading down with oil in general in Canada. But the thing is, you're getting a decent dividend while they're buying back a material amount of themselves. And the balance sheet's already basically immaculate, in line with some of the best in the industry. Finally. It took them a while. They're finally there. And now we should see share buybacks go up. The cool thing about Vermilion is that a decent amount of the cash flow comes from TTF, which is the Netherlands hub. And that's just, you're basically getting way better prices in terms of natural gas production prices for the commodity producers still on the European side. and they're getting that. So they're trading like a Canadian oil and gas stock, but at the same time they're priced, their actual cash flow is coming down the TTF side. So you're getting all this cash flow while the valuation is cheap, and that should just compound the buybacks. Like this company could buy back 10% of themselves this year if prices hold. Again, that's a big if. You never know if oil companies and what the commodities will do in the short run. Airbnb, just an amazing business. One of my favorite in terms of scale. So I always keep adding a weakness whenever I can. Though it hasn't come, like the valuation's never been super exciting. It's always been priced. Most people that follow the company probably know that it's priced this way for a reason. And that's just the scale, right? Just imagine you're getting 14% take rate on everything, and then 3% from the host. So you're taking 17% of everything that's on your platform. And the thing is with Airbnb is that you can match the AI. So like when you have demand coming in, you know people are looking here, you can just match the supply that you know is there to them. You can like match make it. And that system of matchmaking is going to get better and better with more AI in the system. And then you have other things like experiences and all the stuff they're trying to do to Airbnb. I just big fan of Brian Chesky as well. Anyway, ASTS Space Mobile. We looked at that one once. I sold most of it just because it popped so much. Like it's not usual to get 1,000% return really quickly. So I usually sell a lot of it and I'll revisit once it gets cut in half again. The thing is, you never know with these kind of moonshot plays because the valuation with what could happen with, we talked about the video and how easy it is for them to scale with the large telcos around the world all at once. The trick is one, execution. They have to get enough in the sky, right? And then it will start flowing through. So you still have that execution risk. And they also technically don't have cash inflow yet, so they should actually take advantage of this pop and dilute, right? Dilute by raising capital, basically shore up the balance sheet, get the cash while it's hot. And that's what I would do if I was the owner. I would have already done it. BlackRock, BLK, just another amazing business. The ETFs are going to keep taking shares from mutual funds over time. I mean, the only people that are still in mutual funds are the people that are okay about paying 2% a year of their savings. It's just insane. ETFs will win over time. BlackRock, the scale shows up over time as well in the EPS number. So that's another one where I like to buy back. It's not exciting again in valuation right now, but that's another one that I really like in terms of superior business. Freeport, it's one of the first ones we did on the channel for copper. I've sold most of it at this point just because it's up 175%. It's kind of just sitting around. I'm always looking for more copper plays. Like we did a couple good ones in Canada, captured a couple good ones, Copperstone and Ivanhoe. But yeah, that one played out a long time ago with Grasberg and the production cadence into what we think is going to be a weakening or a strengthening copper price into the 27, 28, 29, 2030 with EPs. So I'm kind of hoping, like, I hoped the China slowdown would have put more pressure on copper and these copper miners. But people are bidding up to copper miners. And the implied price of the copper that's underneath them is higher than what the spot is. So people are kind of jumped on that idea. So there's not as much value right now to get excited about. IMAX is another great company, superior position in the exhibit space. You'll keep seeing them take share from all the other exhibitors, mainly just because I believe people, when they want to go to the movie, they want to pay for experience. They want a premium experience, they want IMAX. Like you saw that when during the Oscars, the directors who won Best Picture thanked IMAX, right? Tom Cruise wants his films in IMAX. The people want their films in IMAX because it gets the big ticket vendors to go out, and it basically helps shore up and make sure the film won't flop. And that's a hard thing because there's a lot of bifurcation right now in the film industry, right? And I think there's still easy comps because right now we're entering Q4, which had the shutdown from the shutdown last year, and then you had Q1 of 24, which was also horrible because there was still no production online. So you're going to comp, you have another 6 months of easy comps. You're going to see really strong earnings per share growth, at least on a year-over-year basis for the next 6 months for IMAX, especially with the film slate that's coming out this next little bit between October to the end of Christmas really this year. Just amazing. And then 2025 looks off the hook for IMAX. So I'm not worried about that one. I like that business model. And the balance sheet is immaculate relative to the exhibitors. Mobileye, this one is probably one I'm going to start trimming at some point. I hate selling losses, but this one, just the execution hasn't been there. The demand hasn't been there. Constantly overpromise and underdeliver. At the same time, though, Intel bought Mobileye in 2017 for $17 billion, and now the market's pricing it worth like 10 or 12 billion. It's just crazy cheap. So on one end, this could be like a moonshot, like ATST, right? Shoots up 1,000% all of a sudden, but at the same time, they just have weak execution, weak plan, weak management, probably strong technology, but they just can't get to market. And I think they need to work on that. So that's what I'm going to keep following, and maybe I pull some off a bit, but still hold some. That's kind of where my head's at today. Spotify just really shot up a lot, so I sold quite a bit of it. Still just keeps climbing up. So this is what I'm holding. Spotify, just an amazing company. I'm not quite the scale of Airbnb, but I mean, when we bought it, it was under a monetized, like podcasts were basically money losing business. They were still just starting talking about taking price on the core subscription business, which they've now taken price. And they're going to do it again and again because they do have a superior product in my mind in terms of streaming music. It's just far superior. I think it's better than Apple Music, but that's just me. So this is Education Brazil one. This one's actually only put up good numbers, and it's just gone down. It's a Brazilian small cap, and the business just keeps executing, and the share price just keeps going down. So this one I'm probably gonna get more excited about soon. It might be one where I go Mobileye into Vasta a bit more, just kind of equate the two out, just because one's performing and going down, and one's not performing and going down. So I'd rather pick the performer that's going down, probably because of style factor, small cap Brazil. Right, BNS, we already talked to banks. Brookfield, I always talked about Brookfield's calls. Just really strong positioning, strong knowledge of where we are in the market cycle. They basically timed the peak in interest rates. They've been buying a lot of things. They believe in the 3Ds, so deglobalization, decarbonation, and digitalization. Basically, just over a long period of time, they've just always performed well in terms of their asset allocation strategies. So I like owning the parent there. E-Split, just another way to play Enbridge with higher dividend. I just like this because there was a huge bifurcation between Enbridge's price, which was starting to rebound, and ENS's, which was lagging. And so I was like, okay, I want to pick on ENS here and take advantage of that spread while getting more of Enbridge, really, and getting a high dividend yield rate, 12%. Fiera, this is one we won't talk about yet. It's one that I'm trying to familiarize myself. It's on the financial side. It pays a pretty high dividend. It just has I keep seeing cash outflows, though the margins are expanding. There's always scale in management companies, investment manager companies in AUM, but I need to familiarize with that a bit more. That's usually what I do. You'll see the position size is very small because that's what I try to start building in, right? And when it goes up 15%, I'm like, okay, there's not really a point to get excited yet. So we'll just keep following it. H&R, so the REITs have finally gotten a bid. HR REIT is just trades like, it still trades at a crazy discount relative to its diversified pool. Like it traded like the whole thing was office for a bit there. Just crazy. Anyway, just keeps buying itself at a discount. It's doing what it can. It's been sold off spun off the Primaris side, so the retail mall side. They just spun it off. They did a lot of things, like they got rid of the over office exposure with the Bow office in Calgary. Everything they've done at H&R side has just been, in my mind, things that I would be doing. So I like that. HMAX is just another financial way, just high dividend. HDiv is one that's interesting because supposedly, according to Hamilton, ETF or rather, they've outperformed they've outperformed the TSX. And so that's interesting. So I'm holding that mainly because the dividend is very high, and I hold that in the RSP. And it's just, in my mind, just what I might do if this keeps continuing and this trade shadowing the TSX while giving a higher dividend yield, so it's outperforming it in terms of total return, and I might start allocating more there because it screens very well on a risk adjusted basis, and it's also a diversified ETF, so not too much value to add there. Power Corp, just in my mind, another amazing company. You basically get Canadian Life, so Great West Life, at a discount. You get IG at a discount. You get a bunch of private things to DBL at a discount, and then you get Wealthsimple at a discount. So Power Corp is just an easy mine to keep getting a high dividend while they keep buying back more shares and simplifying the business. Saphira Plus is a hard one. This one's propane tuck-in, or it was, and then they started going to Certarus route, which is more renewable, and I think a lot of investors wanted that tuck-in play. The propane is buy the mom prop tuck propane and tuck it in. A lot of companies actually just focus on tuck-in plays, and I think it's churning that user base over right now. And to be fair, the demand for propane is skews heavy to weather. And the last 3 or 4 years have been hotter than normal, than that 5-year average. Like if you look at the earnings calls, and most of their earnings come in Q1 and Q4, so the winter. And so what we're trying to see here is when eventually, now it is super cheap relative to itself, long-term average as well, but eventually it's going to get colder than its 5-year average. And I think the demand spike is going to show up and this thing's going to take off. The business itself is pretty stable. People that need propane are going to keep using propane. The reason why it still exists. And the tuck-in play is smart. And Certarus so far has put up better than expected results. They tucked it in quicker. This is what I'm going to keep following, especially in the next this winter time right here. Let's see if it's going to be warm again. Maybe the thing just sits around again. I keep getting pretty high dividend. This is the one that I may revisit or not, just because it's not performing like I thought it would. But at the same time, it's hard to know because it's got so much weaker during Q2 and Q3, which is they're not really events for the company. So I'm excited to see what Q4 and Q1 they can put up in terms of EBITDA. But yeah, very high dividend play as well. And then TransCanada, so another pipeline play. Tourmaline, we talked about nat gas and lowest immaculate balance sheet, lowest break even there is, and their access to ports like the JKM, so the JK marker, Japanese Korea marker. They've just entered into smart contracts at smart times in terms of getting their product to market around the world at higher prices. So they've just done an outstanding job, and it has a standing balance sheet, and it pays whenever the prices shoot up. They pay a special dividend, and that's also very nice. And that is Tourmaline's also last man standing status. If things were ever really bad for a long period of time, Tourmaline would be last man standing. AT&T. So this one I've been recently trimming. It just keeps hitting 52-week highs. They're getting close to it. This was one actually during the lead poisoning thing. This thing shot down to $13. The core business was actually improving at that time. Like we actually saw ARPU continue to go up and users keep going up, right? And we finally saw the melting ice cube of legacy voice continue to decline and business wireline continue to decline, but they actually started offsetting some of that with the fiber build out. So this company is interesting. It trades still relatively cheap, especially relative even to Rogers or Bell or Telus in Canada. So it's hard for me to sell it, but there's just other things out there that are looking more interesting. BTI, this is one I was starting to familiarize myself with, and then it just took off. This one I keep seeing on FinFoot a lot, but we've done a video on tobacco and BTI actually, I think, so I don't need to go too much into that. I'm already talking longer than I wanted. Celsius, so this one's interesting. We've done a video on this one. It's finally come back. I've started to add. I'm probably going to continue to add in the 20s if it gets there. I'm kind of hoping. Again, it probably puts up a buck something this year. Maybe $1.80 the next year, right? So I'm not getting excited at $31, right? 30 times earnings. But this growth rate on this thing is special. And if it can do what I think it can do, then I'm probably starting to get a deal already. So that's what I think about Celsius. Lex and FinTech, just it's an interesting. We did a video on this one, the China play. I might start adding to that again. Recently, China's got a little bit of a bid. I kind of want to see if how the consumer responds to the stimulus that's starting to come out. Because China's been going down for 4 years. The equity market's gone down for 4 years now. Just crazy when you think about it. Just nothing but down. So anyone who's recently turned 18 or 22, all they've seen is down in the stock market, which is total polar opposite if you were American and turned 18 4 years ago. All you've seen is up. So just a different mindset. And then so is one I picked up yesterday. It's just selling off in terms of what they decided to buy, and this business is also interesting in China. Paramount's one where I'm probably going to try to sell a bunch out at 15 or whatever it is. Hopefully half at least, and then I'll put it somewhere else. Maybe Celsius, maybe Lex, and maybe Maninso, maybe Stoneco. It's coming back down. We've done a video on Stoneco. Part of that is the interest rates again. So now that banks are Brazilians starting to raise interest rates again, that actually will hurt Stoneco in the short term. So it has to price that out again, just like the last cycle. These are kind of like mini cycles that Brazil's going through. Uber, this is one just crazy scale. It's kind of like Airbnb, but not as amazing. This company is just, in terms of market leading for food delivery and for mobility, it's second to none. People like to put Uber and Lyft in the same sentence, and that's a mistake. Lyft isn't even close to what Uber can do. Vale is just iron ore producer in Brazil. We saw a lot of weakness in Brazil. We still are in the small cap. Vale finally got a little bit of a bid. It just a really nice balance sheet and the cyclical nature. We know it's cheaper because iron ore has been collapsing for a bit. Slow down in China, blah blah blah. So it's recently caught a little bit of bid, maybe with China stimulus plays, but this in the long run, I'm not too worried about Vale. It's kind of just something to add. I was hoping to add under 10, but it kind of bounced a bit lately. Google, just another amazing business. You get the all the search revenue, which is improving with AI. Like the ROIs continue to improve each and every year. The return on ad spend for all the people that spend on Google continues to go up. Digitalization, digital advertising just continues to take share. And you have YouTube, which obviously I'm a big fan of. Just user created content, all you get is money. And then you have all the other stuff that they have, like Waymo. It's just in DeepMind, and hopefully it'd be nice to pick up more Google if there was more weakness on search losing to ChatGPT. But I use ChatGPT all the time, but I also use Google all the time. So I don't see them being mutually exclusive like people like to think they are. ATCO Gas, so this is ATCO Utilities, finally got a bid. The PBR cycle worked. I've been recently selling it mainly because a lot of utilities and REITs are finally getting a bid, so I can try to, they're no longer the obvious things to buy. So now I'm trying to find other obvious things that are obvious to buy that are good businesses, like Badger. So Badger's the one that actually took some out of ATCO and put it into Badger, and some of ATCO and put it into Reitman's as well. Badger's just a tuck-in play. I think I'm going to do a video on this to explain it a little bit clearer. It's a HVAC tuck-in play. It's Canadian, but they're actually expanding a lot into the States right now. And just think of a very fragmented truck market. Like most mom and pops might have 1 truck or 2 trucks or 3 trucks, or a successful mini company might have 30 trucks. This company has 1,000 trucks. So it gives you an idea. So it's the company that, like, we saw when I did a nutrient video, I actually saw them at the plant, and you're gonna see that, like, they had a big business with TransCanada. So they're like the client, the HVAC company that the big guys use, and I don't think there's enough competition for these guys, so they're just gonna keep talking it in and growing. So I think this is another heading Canadian gem, not priced nice yet. So I'm hoping that it gets like a sell, like a no-brainer buy, but I mean it's priced like because it's been performing so well and likely to continue to do so. That's what it's priced like. We talked about the banks again. Here they are. Dynamic Power, so there's a bunch of small cap growers really in the States. Just buy it in the Canadian dollars. Reitman's actually continues to perform quite well. Started to add some again. Somehow this company is starting to put up really good numbers during a slowdown in Canada with unemployment going up. They're putting year-over-year sales growth with a declining store count. So the new management there seems to be working. I want them to buy back more of their shares quicker because they have more cash on the balance sheet than what the company's worth. So I'm excited. The recent call on Thursday was just amazing. I was like, well, how is this happening? Because I have all these other companies, like crop retailers, that are putting up crap numbers. Then I have Reitman's that's putting up year-over-year growth. Price like is going away. So I was like, oh, man. It's just, maybe it's a fluke quarter like the market's suggesting, but I don't know. I talked Shopify, I own it there. Suncor, just a really strong oil and gas play. Sold most of it at this point. There's also an earlier video we did. The Fort Hills acquisition makes sense. Finally got it all in lockstep. New CEOs. Kruger's pretty good. There's not too much to add at this point. I've kind of just, it's not as exciting, right? Because it's gone up so much. Ticks, this is one that I've been slowly trimming down. This one was disappointing. It's a TELUS one that underperforms. Kind of similar to Mobile. I buy it for a reason, and all they do is underperform. Fail to execute, failure to guide. So I'm just taking it out for now. I've actually added to Vermilion as it pulled back. Right, going from one that's down 21 to one that's 13, but it is what it is. Walt Disney is another one I picked up, and that's one that I might use, like swap Paramount to Disney once I get some out for Paramount at the takeout price. There's some Airbnb again. We already talked about that. I think I'm going to do a video on Dollar Tree. I know we did Dollar General. Dollar Tree, very similar, but different. Dollar General is more rural. very poor, basically the places where Walmart cannot go because the population density isn't there. Dollar Tree, on the other hand, would compete, and we've seen the shift from basically the dollar stores to actually make higher margin on disposable products or dispensable income. So like things you don't eat. So things like toys and stuff, they actually make decent margin on that. Whereas food, they make less margin on. And we've seen the sales shift to food because the poorer people, especially in the States and Canada, are just pulling back so hard. And so we've just seen the sales mix shift to consumables, and it's hurt the margins on them. And it also hurts traffic trends in general. But I mean, usually what happens if Walmart's not taking a shit, they're just not eating, right? Because those are usually the cheapest places to get consumable food, the dollar stores or Walmart. Pinterest is just another amazing business, I think, in the long run. This is one we need to see them execute, but it looks like they can. I just need to see it, and then I'm going to get very excited about it. But this company could be up there with Airbnb in terms of scale at some point. I just need to see it. I need to see the ad dollars from the big guys flow in, like the Walmarts of the world. I want to see that flow in more to Pinterest, and I want to see if they can get the better return on ad spend on their platform. I think it has all the ingredients there to do it. I just need to see ARPU go up. If I see ARPU start going up in every single region, I'm gonna get very excited. But until that point, I'm just kind of holding off before I get too excited and add a bunch. Yum China, another Chinese place, finally picked up a bit. This company also, all they've done is execute record numbers, and the share price was just getting cut in half because it was Chinese. So just bought that because of that. What else is there? Amazon. So these are just ways to buy Amazon with a basically covered call play. So you got the Amazon appreciation, but you're also getting the income from the covered calls. Diversified royalties, so Mr. Mike's, stuff like that. Just another stable company. You're getting a really strong dividend. Recently caught a bid. HMAX and HG, we were talking about that. Recently caught a little bit of bids. Keg, we've actually did a video on this during COVID, during the COVID shutdowns. I recently started a position again just to start following it. I was kind of hoping for more weakness in Canada on the discretionary side to hurt these keg sales and stuff, which this is a royalty play would ride on, which is not happening. Lululemon, I finally got cut in half. So that's an interesting business, right? Because it does have a high growth. So I'm looking at that. I might, in terms of the strength of the other ideas, it's harder to underrate it even when it's been cut in half. But that's not technically a catalyst, so I need to familiarize myself with that. What's going to improve in the next year? Nexus REIT again got a bid with a lot of the other REITs. That was actually an industrial play that had the in-place rents a lot lower than the current market rents, so it was like an easy. In my mind, that's an easy buy. Nvidia. This is again a covered call play on Nvidia, so that pays you like 20% dividend on an annual basis. You pay it monthly, but 20% dividend. And you also get the appreciation of Nvidia over time. This is just what I want to slowly focus on over time, just to see how it performs relative to the underlying Nvidia stock. So it could be fun. Nutriem did a video on that one, and adding to that slowly over time. So again, I'm kind of hoping for that 50 handle. Pizza, there's another royalty company recently caught a bid. Same with SGR. It's another REIT that caught a bid. SGR is just a grocery anchored REIT. Pizza, just think of Pizza 73. Spirit Plus, we talked about propane. Tesla, same idea. You basically get another like a 20% dividend because you're basically making money off the volatility, or you're slowly riding the appreciation of underlying shares. Just another. All those ones all have implied leverage. One in the fund itself, and two in the option strategy that they use. So you never go balls to the walls with those ones, but there is something to underlie the portfolio if you wanted to overlay it with income. Especially when I don't own any Tesla, Nvidia, or anything right now. Obviously, this position size is small relative to the overall portfolio. Anyway, those are all the positions. How I kind of treat them. It's already 31 minutes before I edit it. How I kind of treat them is I kind of say which ones are large cap growth, which ones are large cap value, right? So you can see a pretty big large cap skew still, right? 57%, or 60% early. I have another one here that I was on the fence about flagging it, so I called it slightly different, just to show the difference. But so 60% large cap, 20% mid cap, and then 20% small cap. That's kind of how I operate it. And this can change, right? If I see a lot of value, because there is a lot of value in small cap value, right? I do like that switch, right? But large cap growth is hard to get out of because it's just performed so well, and but again, what I'm trying to do is trim these to go to the underperformers, right? Trim some of these and go to the underperformers, which lately have been small caps for the last 5 years, 4 years, right? That's style size. This is kind of by sector. It's not true sector. It's not like JIP sector, but it's how I view it in my head. So technology, financial is both fairly high, but technology and software. So this is like your what I call softwares: Uber, Spotify, Airbnb. Those are kind of three of my bigger software app ones. So it would represent a decent amount of my portfolio. In my mind, because they're really strong business models. The margins and the scale that shows up when the sales growth improves is just really strong. Whereas technology, I might feel like something like Google, which is still growing very well, but it's not technically a software app. That's just how I split it out just a little bit to help me. Oil and gas still relatively high. Like this would be outlandish for most people because oil and gas has been where dreams go to die for like a decade. But there's just a lot of value there. I was trimming it before, now I'm starting to add back. A lot of this is Vermilion, probably 5% or 4%. It's Vermilion. Entertainment, so that's your Disney and Paramount. So this is one where I'm considering about changing out. In consumer discretionary, it gets harder to pinpick them, but you can kind of where the overweights are, so where the outperformance is lately been versus where some of the weaker ones are, right? Like I probably should have had more REITs, especially in the last 15% move that they've all kind of had in lockstep, right? But they've all moved up pretty nice, so that's not the end of the world. A decent amount of pipelines and defense and stuff like that. And then another way I like to look at them is basically by like use case, like which ones are more speculative, which ones are more defense, so which ones can basically used to buy the things I want to buy later when they get cheaper. That's usually what I call defense, right? So like the real estate REIT plays, right? The Bank of Nova Scotia, I view these more as defensive plays. Nutrient is more of a defensive play. Gas is a defensive play, right? Whereas speculation would be REITmans because it's so small, right? Even if I think it's could somehow price like it's going away, even though it has more cash than it does than the market cap is worth, right? That's just kind of how I treat things. So like where things are defensive, when defense is finally getting a bid, so now I can go back into growth again, right? That's kind of how I do it. In terms of position sizes, this is kind of like when it's all summed up, like how much in each one in Canadian dollars, right? So you can see probably overweight Vermilion more than I was expecting. A little bit Airbnb. I was actually surprised BNS is that high. So I'm not that excited about the bank. I just knew it was undervalued for some time. So this one's probably what I would do is an indicator for me that okay, I have a defensive Canadian dividend here. What else can I buy with it? Or if I think it's just going to be an average bank at this price, should I just buy HMAX or something like that and get a higher dividend and diversify across the other banks as well in Canada, right? Do I think it's going to keep outperforming? That's really what I'm trying to say. Pinterest, so like most of these, like Airbnb is great business. I'm not worried about that. Pinterest is a great business. I want to buy more on pullback. Outfit's a great business. I want to buy more on pullback. IMAX, great business. I want to buy more on product. So these ones all make sense, right? So Vermilion is questionable. Bank of Nova Scotia should probably start trimming. Paramount Global, I'm planning to get half out at the $15 buyout, whatever it is, right? We'll see. We'll see how it unfolds. Spear Plus again skews higher than I was expecting. So maybe that's another one where I could see Canada. It's defensive. Should I trim some? Because it's one of my losers, right? Again, and then another loser, three losers technically right here, Superior Plus, Celsius, and Mobileye. Are there other things, like why am I wrong, right? So far Celsius has performed like I thought it would. We knew the growth was going to slow, and you listen to the video, and we're finally getting a decent price, right? Now this can last for a long period of time, but usually the growth is never accelerated as long as the product is still strong, and it keeps taking share from the other ones still, even during a pullback in the category overall. So that's the most important point. Or are they still taking market share while things are slowing down? And they are. Whereas I can't say that about mobile. All it has underperformed, right? So this one is kind of on my axe to just at least trim and reset, to take at least some of the losses and move it to somewhere else. What else? Brookfield, we kind of talked about. I'm fine with that size. They'll fine with that size. PayPal's one maybe I could consider superior to PayPal or something like that on the Canadian side. Or if I want to hold in the US, go Mobileye, PayPal. It still screams very cheap. ENS, Enbridge, just my mind, just a nice business, nice dividend, very constant. Stoneco's interesting because it's getting so weak, but I would need to revisit kind of what the interest rate expectations are for the next bit here, because this company can really churn out EPS if it wants to, I think. Shopify not worried about, Uber not worried about, Tix is probably one that I'm going to keep going down. I think I already did, that's why I didn't show up as much. I think I bought Reedman's with it. Vasta, so that's Brazilian Energy one, that's one I probably should have, so that's one where I could consider some Paramount or some Mobileye to Vasta. I mean, that's just kind of how I think about things. It's not perfect, but it's kind of how what things could I augment, what things are going wrong. It's kind of how I view the portfolio in real time, like I am right now, and just kind of saying, okay, what do I think of this? What's going off the mark, right? What things are working? What's currently getting a bid? What's currently left for dead, right? And that's just kind of how I treat things. And then there's certain things at the bottom here, like I've already trimmed Polaris, finally pulled the rest of it out, right? And like, are these small positions even worth owning because they're not going to move the needle, right? Or I just want to follow them to familiarize myself with it, right? Like BTI, do I want to hold it, such a small position? Or should I axe it and just roll it? But I like to follow it, right? And some of these are things that I just like to follow, or they're legacy positions that I've sold most of it, but I just like to follow it anyway. So when it gets cheap again, I can just no-brainer buy it because I know enough about the business to be comfortable doing that. So that's kind of what a lot of these on the far end are. They're just kind of legacy positions or new positions where I'm trying to familiarize myself with the business, like Fiera, right? Or like Nutrien, like we just did, and Lexington Tech, right? Just familiarize myself. So that's kind of how I view things. I know a lot of people like doing the percent things, but I like to see it like this. Anyway, that's kind of like my general thoughts on all the positions. Again, if you have any names you want me to look at, do a deep dive on, I'll look at some suggestions. I know I get a couple DMs every now and then, and I'll do a video when I get back. But yeah, anyway, heading out to Nashville tomorrow. I will talk to you guys later. Have a great weekend.